Friends, today we are going to learn about Accounting Standard 16 on borrowing cost. What is the meaning of borrowing cost? Friends, as the very phrase indicates, costs related to borrowing. Costs related to borrowing. When you borrow money, there will be costs related to that. This accounting standard deals with borrowing costs. Okay, so now when you say costs related to borrowing, what kind of costs can we have? Imagine there is a company which wants to take a loan from a bank. What kind of costs can that company have? Well, when the loan is being sanctioned, there may be processing charges or stamp duty, etc. for the loan documentation. Such things might be incurred. Then, after the loan is taken, periodically there will be an interest outflow on the part of company, right? So that's also these kind of things are considered as borrowing costs. Costs incidental to borrowings made by the company. What the accounting standard makes very clear is these should be real borrowings. This interest cost or borrowing cost what we talk about should be really the cost. It should not just be a notional cost. So what do I mean by this? You cannot say it is assumed that on the share capital 10% should be paid as return and there is a notional interest. No, you cannot take any notional return. There should really be borrowings and on those borrowings there should really be cost. Okay, but what is so special about borrowing cost for an accounting standard to be issued on that? Friends, if there is an interest expense, what journal entry do we pass? One account will be debited, another account will be credited. Interest is an expense. If that amount of interest is paid means cash will go out, right? To cash or bank. So cash or bank will be credited. Which account will be debited? Interest expense account will be debited. Very clear. So interest expense account debited to cash or bank. Then if that interest is not yet paid, well, it will just be payable. Interest expense account debited to interest payable with that particular amount. If that interest is already paid, cash or bank will be credited. If interest is not yet paid, interest payable account will be credited. Now, after passing this entry, you will pass one more entry where that interest expense generally you charge off to P&L. So that interest expense you will take and directly drop into P&L. P&L account debited to interest expense. So in this entry, interest expense will be transferred to P&L. Normally, interest expense will be charged off to P&L. So just imagine, you take interest expense and drop it into P&L. This is the most common thing what we do. But in certain cases, we don't debit interest expense to P&L, we debit interest expense to that particular asset account. I repeat, in certain cases, we don't debit interest expense to P&L, we debit that to that particular asset account. When do you do that? How do you do that? Why do you do that? All those things you learn as a part of this standard. The definition as per the accounting standard is as follows. Borrowing costs that are directly attributable to acquisition, construction or production of a qualifying asset form part of the cost of that asset. Friends, normally what did we understand? Borrowing cost, something like interest cost, etc. generally will be charged off to P&L. But if such borrowing cost is incurred in relation to a qualifying asset, what is the standard saying? It should not be charged off to P&L, it should be debited to the asset account. So here we will understand some interesting aspects. When will borrowing cost be eligible for capitalization? When I use the word capitalization, it is basically trying to indicate that it will not be debited to P&L, it will be debited to asset account. That process is what we call as capitalization. Okay, so when will borrowing cost be capitalized? Borrowing cost will be capitalized if it is incurred in relation to qualifying assets. Acha, then what is a qualifying asset? Let us understand the meaning of qualifying asset in simple terms and then we will look into the definition. Friends, qualifying asset is an asset which takes substantial period of time to get ready for its intended use or sale. It is an asset which takes substantial period of time to get ready for its intended use or intended sale. What could that be? Imagine you go to a car shop, car showroom, and you buy a car. Is that car ready for its intended use? For that you should ask yourself, hey, what is the purpose for which we are buying the car? If it is a general purpose of running that on the roads, well, car is pretty much ready in the showroom and as soon as it comes out, it is good to run on the roads. So, well, you actually don't have any more expenditure or time that has to be incurred to really get it ready to run on the roads. So, car cannot be called as a qualifying asset because it is not taking substantial period of time to get ready for its intended use or intended sale. Listen carefully. I am using the phrases intended use or intended sale. Intended use means fixed asset. Intended sale, current asset, inventory. Qualifying asset could be a fixed asset or a current asset like inventory. It could be either. So, if an asset takes substantial period of time to get ready for its intended use or sale, only then we will call it as a qualifying asset. In our example, car is not a qualifying asset because we said we want to use car for the regular purpose and as soon as it comes out of showroom, it is ready for that purpose. So, it does not take any substantial period of time to get ready. So, we cannot call car as a qualifying asset. Now, what will happen if car is not a qualifying asset? When you take a loan to buy car, interest what you have to pay on that interest cost should be debited to P&L. It should not be added to qualifying asset. It should not be debited to qualifying asset. When can we debit interest cost to asset account? Only when it is a qualifying asset. So, if the asset is not a qualifying asset, interest cost will be charged off to P&L. Then, you take a loan and with that money you buy shares of a company. Now, tell me, when you buy shares of a company, is there anything like shares getting ready for their intended use? Is there anything like that? No, nothing, right? So, what is that? What is there in the shares to get ready for their intended use? There is nothing like that. So, any money what you raise from banks to purchase shares, the interest what you pay on that cannot be added to the investment account, that is the asset account, because there is no qualifying asset. When I say there is no qualifying asset, that asset does not take any substantial period of time to get ready for its intended use or intended sale. Now, look at another scenario. You are purchasing machinery. That machinery is available off the shelf. You bought that machinery. After buying that machinery, you have to spend about 6 months of time to get that machine ready for its intended use. Listen carefully. It is not ready right now. To get it ready for its intended use, you have to spend 6 months on that. In such cases, whatever money you are incurring on purchasing that machinery, for that if you have taken loan, interest cost what you pay on that, can we debit that to asset account? It depends on whether 6 months is considered as a substantial period of time. Recall, only if the asset takes substantial period of time to get ready for its intended use or sale, we can call it as a qualifying asset. Now, what is substantial? Accounting standard says generally 12 months can be considered as substantial, but it is not hard and fast rule. 3 months, 4 months, 6 months, 10 months, whatever company decides, that will be considered as substantial. So, it depends on what the company decides. So, considering all these points, friends, particularly from your exam point of view, what should you bear in mind? If a question tells you 6 months, 10 months, 1 year, 2 years, whatever, You should write this point clearly. If this period is considered substantial, then we can consider it as a qualifying asset. If this period is not considered to be substantial, then it is not considered to be a qualifying asset. If it is considered to be a qualifying asset, then interest cost on that qualifying asset can be debited to asset account. On the other hand, if this is not considered to be a qualifying asset, interest cost on that cannot be debited to asset account, should be charged off to P&L. Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Examples: manufacturing plants, power generation facilities, etc. As I mentioned, what is considered as substantial period? Accounting standard interpretation talks about what is considered as a substantial period. Ordinarily, a period of 12 months is considered as substantial period of time unless a shorter or longer period can be justified on the basis of facts and circumstances of the case. Thus, a rebuttable presumption of a period of 12 months is considered a substantial period of time.